All right, thanks, Yubi, and thanks everybody for coming out and hanging out with us today. Afternoon for probably most of you guys, but it's actually morning here in Las Vegas. First of all, first and foremost, I want to thank Mr. Topstep. I mean, they provide an excellent service. I've been working with Danny Riley and Brian and all those guys at an execution desk for years, probably almost a decade, so a long, long time. But they also run, obviously, Mr. Topstep, which is a fabulous, fabulous source for day traders. I mean, I can't say anything, I can't say enough about it. They do a really, really good job, and they're very honest. It's not like a lot of the other services out there that will promise you the moon but can't deliver. I mean, these guys really do a great, great job, and very good people to work with. Anyway, today we're going to talk about day trading truths and myths. I'll tell you this up front, we're not going to reinvent the wheel here. We're going to talk about things that you've probably already been introduced to, a lot of basic topics. But what we're going to do is maybe just remind you of how important these things are and give you maybe a little different perspective on how to look at things. I mean, for example, we're going to take some of the things that you've learned from, Trading 101, this is just a broad example, but everybody and their dog knows that when you're trading options, you should buy options on low volatility and sell options on high volatility. But guess what? 90% of the traders out there want to do exactly the opposite. They see crude oil up $3 and they want to buy call options, but they should, instead of buying call options when they're cheap, they want to do it when it's expensive. Things like that are really what makes all of the difference in trading. A lot of people know what to do, they just don't do it. There's no follow through, and we're going to just remind you of all those things that you really should, that you know, but you need to make sure you follow through on. Before we start, I have to, it's my job to warn you that there is substantial risk of loss in trading futures and options. It's not investing. Although the markets can really be anything you want them to be. If you want to use the futures markets as an investment vehicle, you certainly can. You take all the leverage out by overfunding your account. But most people don't do that. Most people are speculating, and they're speculating on leverage, and so there's definitely a lot of risk involved. I don't expect everybody to read this slide, but I'll give you a brief summary here. The idea is past performance is not indicative of future results. If we're talking about examples in this webinar, or if you've followed our newsletters or Mr. Topstep's newsletters, just because we have a great trade today doesn't mean we're going to do it again tomorrow. It's speculating. We don't have a crystal ball. We do the best we can. We do our homework. But in the end, we're all trying to do the same thing, which is beat the markets. And if it was easy to do, obviously, life would be a little different for all of us, right? I'll just give you a brief background on myself. My name is Carly Garner. If you have any questions or comments or concerns, you can certainly reach me by email or by phone. If you're on Facebook and Twitter, look us up. On Twitter, our handle is @CarlyGarner, and on Facebook, if you just type in DeCarly Trading in the search box, you'll find us. We'd love to see you there. I wear a lot of hats, but primarily I'm a broker for DeCarly Trading. That's what we do. We're a brokerage firm, and I'm also a market strategist and an author. I write a couple of client newsletters, the Financial Futures Report and the DeCarly Perspective. You can certainly sign up for a trial of those on our websites if you haven't already. And I also write a column for Stocks and Commodities magazine. I've written 3 books. And we've basically covered the gamut here. If you're looking for commodity trading, there's something there for you. If you're looking for currency trading, we've got that too. And Trader's First book on commodities, I'm actually in the process of rewriting, and the second edition will be out next month. And a rewrite was necessary because so many things have changed. I mean, the technology has really changed the business. The recent collapse of MF Global and PFG has changed the way we all look at futures trading and the safeguarding of funds and all those things. So we wanted to make sure that we tried to keep it current. And for the sake of time, I'm not going to really run through the overview slide, but like I mentioned before, we're not going to reinvent the wheel. We're just going to give you a new perspective and remind you of how important these things are. I'm telling you, it's the little things that make the big difference. You can read a million books and you can use a million different indicators and tweak them, but if you don't stick to the basics, you're gonna have a hard time making money. All right, why day trade? Well, there's a lot of strategies out there, obviously. You can position trade, you can swing trade, you can trade options, but there are definitely some compelling arguments for day trading. Most beginning traders like the idea of day trading because there's a low barrier to entry. You can open an account with a couple $1,000s if you wanted to and trade on very low margins. There's no overnight risk. You can sleep at night knowing that if the world's ending, then at least you're not losing money in your futures account. And let's face it, it's exciting. I mean, day trading it's adrenaline. You basically speed up the profits and losses of any type of strategy. The same technical indicators that you would use on a daily chart or a weekly chart can be used on an intraday chart, and people like the idea of that. Now, I'm not saying that day trading is for everybody. In fact, day trading is probably one of the toughest ways to make money in the markets. So it's not for everybody, but for those that can find a way, find something that works for them to be consistent, there's definitely a lot of room for success there. It's not easy, but nothing is, right? The downfall of day trading, especially when you're talking to newer traders, is that maybe the fact that it's exciting was a positive, but it's also a negative. The flashing lights, the quick fills, and the adrenaline, it gets the best of people a lot of the times, and that's where discipline comes in. It's tough. It's easy to say discipline, but it's tougher to do it, and that's what we're going to talk about today. Day trading basically magnifies the exposure to destructive temptations. A lot of day traders, I'm not talking about the guys that have been doing this forever and are successful at it, but I'm talking about the general population. Unfortunately, they tend to overtrade because it's so easy. You can buy an E-mini S&P with a click of a mouse. When things are that easy, there's a lot of room for overtrading. And I've learned personally that the people that are successful in this business or in trading are the people that trade less. The more you trade, the higher the probability that you're taking less than high probability trades, and the more you're going to get yourself in trouble. A lot of traders, they have the tendency to over leverage, and the idea of over leveraging is, one day it might pay off and you might hit big, you might be in the right place at the right time, but in the long run, if you're a trader that over leverages, at some point it's going to sneak up and bite you, and it's not going to be a pleasant experience. A lot of day traders have a tough time with emotional decision making, and a lot of people try to force trades during economic announcements. I actually believe that most traders are probably better off being on the sidelines when something like the non-farm payrolls comes out. I mean, anyone trying to trade bonds yesterday, if you happen to be on the right side of the trade, it was a fabulous day. But for those that were in the wrong place at the wrong time, might have had a tough day. Day trading is mental. I cannot emphasize this enough. I've seen traders that take the exact same strategy, same signal service, or the same system, or whatever it is, and one guy will make money and one guy will lose money, and it boils down to how they handled themselves when times were good and how they handled themselves when times were bad. It's really a mental game. I believe that it's a lot like sports. If you've ever played sports, your coach will tell you, it's 95% mental and only 5% ability, and I think that in trading it's the exact same thing. Thomas Jefferson once said, "Nothing gives one person so much advantage over another as to remain cool and unruffled under all circumstances." And this is absolutely true in trading. The person that can stomach the losses or enjoy the good times without getting too overconfident is the person that eventually is going to be a successful trader. And you've all heard about the emotions that come with trading: fear and greed. We're just going to brush on this real quickly. Obviously, you're aware of these concepts, but the biggest fear in trading is the fear of being wrong, but that's a natural fear. If you're not scared, then you're probably foolish. Somebody that's trading foolishly, they believe that they're always going to be right, or for some reason know more than everybody else. They're probably taking on too much risk, and eventually they're going to blow out their account. A very smart trader once told me, is Larry Williams, I'm sure you've heard of him, but he once said that anytime he gets into the market, he assumes that he's going to lose, because he knows he doesn't have a crystal ball. He knows that he did his homework, and he believes in what he's doing, but there's no guarantees. The thing about fear is you want to be able to recognize if you're feeling these types of emotions. If you're the type that, if you're in a state of mind in which you're trading too much and you're just getting overly complacent, you're probably just setting yourself up for failure at some point. And recognizing these things is really the key to riding through them. Somebody that's too fearful, if you're all the way on the other side of the pendulum, you're probably going to be late to enter a trade, early to exit. Obviously, ideally, we want to be humble. We want to be well researched, well educated. I know this is easier said than done, but one thing to keep in mind is if you're trading a smaller account, make sure that you're not over leveraging. You're not using too much margin. If you only have to trade one contract at a time to fit within your means, then by all means do it. Anytime that you're trading beyond your means, you're amplifying the emotional experience. And like I said, trading is 95% psychology. So if you're amplifying all the bad parts of your mental capacity, the odds are not in your favor. Gordon Gekko once said, "Greed is good," and I think he's probably right in some aspects. Greed is what brought you to the futures market in the first place. Greed can create opportunity, but it also creates misery, and that's the key here. You have to remember when you're trading. Everybody always asks me, "Well, Carly, if I buy crude oil and it goes up $1, how much do I make?" But nobody ever says, "If I buy crude oil and it goes down $1, how much do I lose?" Because people don't think that way. They think they're very optimistic when they come to the markets. And I'm not telling you should be pessimistic, but I'm telling you should be realistic. You should understand that trading is a very difficult venture. There's risks involved, and you need to keep that in mind when you get in the market. Complacency is the biggest problem with most traders early on. They just really don't respect the fact that the markets can be mean. And they are. The markets are mean. This is just a personal preference and a personal opinion, but I think it's important to at least consider. A lot of day traders, they use stop orders and they trail their stop, and they basically wait for the market to come back and stop them out to get out. But I'm the type of person that by definition, stop orders are only triggered if the market moves against you. So why don't you just place a limit order, take the money when you've got it, and live with the consequences. You might leave a little money on the table, but in my opinion, I believe in the long run, you're probably going to get out at a better price if you're working limits near resistance than you are by trailing a stop. Because again, stop orders mean you're getting out when the market's already going against you. And another thing is, it's okay to be greedy to a point, but you don't want to be too greedy. I see this all the time, and it's a very simple fix, but it happens a lot. Let's say, for example, you're long the E-mini. You're looking for 1407 in the E-mini. You've got a limit order working there. If the market's at 1406, but you're already up 5-6 handles, take the money. I mean, who cares? It's an extra $50. That's nice. $50 is real money, but a bird in the hand is worth two in the bush. I've seen a lot of people turn winners into losers just simply because they were looking for that extra $50, $25, and it just didn't happen for them. Every book you read talks about fear and greed, but not all of them talk about frustration. It's kind of the same idea, but frustration is basically bringing that baggage from one bad trade into the future, and you allowing it to dictate future trades. A lot of traders that I talk to get very worked up. they put a trade on, they make some money, they get out, and then the market continues to go in their favor, and they look at all that money that they lost. Well, in their mind, they think they lost it because they got out too early. But I'll tell you what, if you can't go wrong taking a profit. If you took a profit and the market goes further, so what? You still made money. So you can't look at that missing out on a profit as a loss, and most people do, and that really can mess with your psyche, and it really can negatively affect your ability to continue trading in a rational manner. A lot of people go to revengeful trading, and this is super unproductive. If they take a loss or they miss out on a profit that they thought they should have had, or whatever the case is, they're frustrated and they start adding size, they start forcing trades, and they start doing things that aren't necessarily within the confines of their strategy. These are all very obvious clues that you need to take a break. Shut the computer down, walk away, call it a day. Or maybe even a month, or maybe even 3 months. Sometimes it takes a while to clear your head and just get all of those emotions out and start from scratch. Now here's where a lot of traders really just don't understand the mechanics of the markets. They spend a lot of time reading about technical indicators. They know everything about Fibonacci. They can tell you, how to tweak stochastics so that it's it works in a certain time frame. But what they can't tell you is how margin works. And what most day traders don't understand is intraday margins are set at the brokerage level, not the exchange level. The exchange tells the broker how much they have to charge for positions that are held beyond the close of trade, but the exchange doesn't tell them how much they have to charge for intraday margin. And what we're finding nowadays in the last couple of years is brokerage firms are getting extremely competitive with day trading margins. You'll see some people advertise $300 mini margins or $500 mini margins. And on paper it sounds great, but you have to keep in mind brokerage firms make a living on commission, and they're using these super discount margin rates as a way to entice you to overtrade. It's kind of like, do you remember the Shards of Glass company commercials, that the cigarette, the anti-smoking ads? Basically, it's the same idea as cigarettes. I mean, these big giant companies are selling a product to people that they know eventually is going to possibly kill them or at least do harm, while brokerage firms that are pushing these deep discount margins are doing the same thing. They know that the chances of you making money with that kind of leverage is slim to none, but they must not care. I don't know, maybe they do and they just don't realize, but to me it seems like they don't care. Another thing that you need to keep in mind is just because a firm is offering a $500 margin or a $300 margin doesn't mean that you can open an account with $300 and trade an E-mini, or nor does it mean you can open with $3,000 and trade 10, because what will happen is they'll let you get into the market, but as soon as you lose a tick or maybe lose a handle on the trade, they liquidate you or they start shaving your positions down. So to them it's commission no matter what. They made their commission whether they let you trade the position out or they force liquidate you. They don't care. In fact, some brokerage firms will tell you you have a $500 margin rate. They'll let you put on a 10 lot in a $5,000 account, and then they'll immediately liquidate you, and they'll charge you $25 per contract to do it. So the moral of the story is be very wary of when you start seeing those types of things, and just know what you're getting into. It's not all that it's cracked up to be. And on top of that, I believe that low margins and over leverage is really a burden to traders, and it provides dismal odds of success. I'm not the type of person that's going to tell you, and this is my opinion, again, everybody has their own personality and their own way of looking at things, but this is how I look at it. I'm not the type of person that believes that every day trader should always absolutely be out by the close. But if you don't have the margin to hold the position that you have on, you absolutely should be out by the close. It's your responsibility to know when the closing times are. A lot of traders don't realize that if they get into a trade in the morning and they offset it in the evening, that they've actually violated their margin requirement, because once the once the session closes, and each market's a little bit different. So I mean, you just have to know when do the currencies close, when does corn close, when does crude close, because each of those closing times is when the margin is calculated. The exchange takes a snapshot margin at that exact time. Anything that you do beyond, the rest of the 24 hours of the day, honestly, doesn't really matter. That's between you and your broker. And most people don't understand that. But the way I look at things is, if you keep your account well funded and it gives you the ability to hold beyond the close, that's a great thing, because markets don't work on time, although they kind of do, because you can see the markets fluctuate on the open and the close as people are adjusting positions. But in all intents and purposes, your strategy, whether it's you're using the RSI or the Williams percent R or whatever the case is, it's not going to go on your time frame. It's going to go on the market's time frame. You're not the boss. You're just, it's not your world. You're just living in it. Sometimes it's a good idea to just take a step back and realize what margin is and why the exchange tells you that you need $5,000 in your account to trade an E-mini. Well, exchanges put these margins and policies in place for a reason. They do calculations, and they have odds makers, and they have all these people telling them exactly what is a quote-unquote safe amount of money to have in an account for one daily price fluctuation. So if you're day trading on less margin than what the exchange overnight rate is, you have to keep in mind you're playing with fire. And I'm not saying don't do it. I'm just saying keep this in perspective and be realistic about how you approach the markets. And again, day trading margin was not granted because there's lower risk in day trading than there is overnight trading. It was granted because brokerage firms want you to trade more. If you're in and out in the same day, that's one full commission. But if you're in and you hold it for 3 days, it took the broker 3 days to get a commission instead of 1 day. Brokerage firms are in business to make money. You have to keep in mind that's what they're here to do. Now, also keep in mind, I'm a broker and I'm telling you to trade less. So if I'm telling you to trade less, you should really take it into consideration, because I make money the more people trade. Be aware of market volatility and understand the consequences. And this is a very, very basic concept. I know that all of you are very aware of this. You all know about the VIX, and you've probably looked at standard deviations, and you can see the bell curves and volatility measures, historic volatility. There's all types of different volatility measures out there. But what I want to remind you is that low volatility is often followed by high volatility. Just because the market's quiet doesn't mean that's the time for you to casually put on a day trading position without any worries in the world, because hey, the market's not going anywhere today, it's quiet. That's exactly when the market's going to come back and sting you. Again, this is my opinion, but this is how I feel. I think as a day trader, if the market's flat and it's not doing anything, there's low volatility, honestly, you're better off just staying away. A lot of people get bored and they want to be in just to be in. They feel like they're missing out on something. But it only takes, in a quiet day like that, usually, a lot of times the volume's light. All it takes is one news announcement, or, one surprise earthquake, or it could be, who knows what it could be. Or it might even be nothing. It might be a fat finger error, or it might just be, some index rebalancing, or something that really has no long-term impact on anything that stirs the market up. Quiet markets basically are opening the door for risk of unexpected and unexplained moves. If you're flat, a trader has an opportunity to take advantage of an extreme price move once they occur. So for example, if the market's trading sideways and all of a sudden we get a crazy sudden sell-off, the market's running stops, sometimes that's a great buying opportunity, because a lot of times there will just, traders tend to put their stops all in the same place. So if there's a bunch of sell stops lining the downside, and for no apparent fundamental or real reason, the market starts running stops and drops in the E-mini maybe 8-10 handles, sometimes that's a great buy. I mean, mentality is, a lot of traders, they want to sell it. They say, well, the market's going down, let's sell it. But more often than not, when you get those type of quick, unexplained moves, they're usually an opportunity to take the other side of the trade. Similarly, in a short squeeze, you don't want to be the guy that's getting squeezed out. You want to be the guy that's flat and there to take advantage of the opportunity when it presents itself. And this is kind of an example. Let's see if I can do this here. You can see the market just going nowhere fast. Somebody that was long or short the market might have picked up a couple of points here or there, but if they happen to be in the wrong place in the wrong time, when the bottom fell out, it's pain city, right? I mean, they might have had their stops, but even if they had a stop placed, they're still not looking at a pretty trade. Somebody that's flat the market, that recognizes this, hey, the market's not going anywhere, there's just not a lot of high probability trades or opportunity. When the market fell out of bed, they probably would look to start buying, probably a little early, to be honest. But I mean, the point is, if you're flat, you can take advantage of the opportunities. If you're already in the market when this happens, you're playing defense instead of offense. And that's not where you want to be. A lot of people ask me almost on a daily basis, which indicators do you use? What do you look at? And I'll be honest, I really don't think that one particular indicator is the magic end-all be-all for traders. I mean, trading is basically competing with all other market participants. They all have the same access to indicators, news, and price data. It's true, you can go in and play with some of the parameters of the RSI or whatever indicator that you're using, and you can tweak it a little bit, or you could even create your own. I mean, a lot of trading platforms out there allow you to create your own indicators. But at the same time, an indicator is still telling you what happened, not necessarily what's going to happen. And so they're all based on the same idea that, momentum and volatility and all those types of things. So I really don't think that there is such a thing as a magic oscillator. I think that oscillators probably in the long run would yield the same results. If you took every buy signal and every sell signal of each indicator, I would guess that probably in the long run you're going to end up having about the same outcome. But it's how you use them that matters. And that's really what's key. Is, again, it comes down to emotional stability and just being experienced. And unfortunately, experience only comes with experience. It's not something that you can get out of a book or coming to classes or anything like that. But that's the great thing of using a service like Mr. Top Step, is you have a lot of experienced traders all in one place giving you guidance. They're not going to tell you exactly where to buy and where to sell and place your stop, but you don't want that, because every trader is different. Every trader is working with a different account size, a different personality. You want to find what works for you. And doing that, it all comes down to experience, but it's great to have a resource where you can sponge off of other people's experience, so hopefully you don't have to learn some of the hard lessons that they learned. It shortens the learning curve, in other words. In my opinion, I have a hard time working with really short bars on a day trading chart. I think that the shorter the bar, the more unnecessary noise is going to impact the technical signals that you're getting, and the quicker you have to be. A lot of day traders think that they'll trade on 1 minute bars and they'll trade a lot of contracts. So like with a $10,000 account, hypothetically they can probably trade a 10 lot if they wanted to, using 1 minute bars. And the idea being, they're trading 10 lots and they're only looking for a handle or 2 handles or something rather minimal. I believe this to be a heck of a lot more risky than trading 1 lot with a 30-minute bar or even an hourly bar. And again, I'm a broker. I'm telling you to trade 1, not 10. So it's something to at least consider. This is just kind of an example of on a 1 minute bar how much noise you can get. I mean, there's really no, of course, there's people that are probably much better at reading charts than I am, but when I look at this, I can't tell you if we should be buying or selling or what the heck to do in here. And if you're trading 10 lots, if these are bonds, if bonds go from 128.20 to 128.27, that's 7 ticks on 10 lots. I mean, that's a lot of money for something that really is, I mean, look, how do you trade off of that? I couldn't find a way. Again, there's people that are a lot smarter than me, but in my opinion, I think you're better off trading less contracts in a longer time frame. The big question for day traders, or actually traders of any type, is should we be following the trend or should we go counter trend? And this is a personal choice. Everybody, again, there's people that have made lots of money trend following. There's people that have made lots of money scalping. There's people that have lost lots of money doing the same things. But the point is, what works for you might not work for the next guy and vice versa. So you find what your personality can tolerate. If you can't tolerate the idea of counter trend trading, going against everyone else, then maybe you need to look for something else. My personality works in a way that if everybody's buying, I don't want to be a buyer. I want to be a seller. Now, sometimes that works against me, but sometimes that might work in favor of traders. But I just want to give you an idea of kind of the difference and how to look at things. Markets tend to spend most of the time range trading and less of the time trending. So by default, trend traders are typically, they are going to have lower win-loss ratios, but their winners can be larger. They're going to get several false signals before catching a trend. The way my brain works is I would get very, very frustrated at, losing and losing and losing, and it would really, it just would be a complete nightmare for a trader like me with a personality like me. It would never work. But a counter trend trader who is looking for smaller profits but more frequent wins, depending on your personality, this might be something that, in my opinion, is probably something that's maybe a little more ideal, because you're going to get fewer false signals, you're going to get less frustration, but you could potentially see some pretty large losers as well. If you're trying to pick a top or pick a bottom, obviously you've heard it a million times. Never pick tops, never pick bottoms. It's a death sentence, and it's true. You have to be careful with doing things like this. But this goes back to again, previously, like I said, every time you enter a trade, you should assume that you're wrong. That way, at least you're not going to complacently hold on to losers until it's too late to come back. Hopefully, again, there's all of us can talk about these things and tell us it's obviously you want to cut your losers, but it's never as easy in the heat of the moment. So again, this is just a big reminder on the basics and really what we should be thinking about all the time. Even though these things tend to be in the back seat, they should be in the front seat. And this is just kind of a chart representing the fact that this is a very normal day if you're looking at the E-mini S&P. I mean, the market goes nowhere most of the time. A swing trader or a counter trend trader would be, looking to sell the dips and sell the tops, obviously, buy the dips, sell the rips, I think is what they say in Mr. Top Step. A trend trader obviously is looking for some sort of a breakout, but here's the problem with the trend trading, in my opinion. Trend trader probably would have gone long somewhere in here, maybe somewhere in here, maybe went short somewhere in here. So you can see there are a lot of times, not always, but a lot of times they're going to be behind the 8 ball. They're going to get in right as the market's topping out, or get in on the short side right as it's bottoming it out. And I wouldn't be able to stomach that sort of a mental hit, but some people can. And the idea is the trend traders want to catch something like this, whereas a counter trend trader probably might have started selling up in here and probably suffered a little bit of a heartache up in this area, but eventually it might have come down for them. But this just gives you an idea of the point I'm trying to make is the odds are that counter trend traders are going to probably win more trades, but they're also going to get caught on the wrong side every now and then and suffer. On the other hand, trend traders are going to lose more trades, but when they do win, it's going to be something something to talk about at the water cooler. Now, this is a topic that nobody wants to talk about. Even brokers don't want to talk about it. But it's important because I think a lot of people have a very, maybe an inaccurate idea of commission, because it makes sense. You want to pay less, right? You want to buy things cheap. If you go to the store, you want to pay less for milk and bread at Super Walmart than you would at Albertsons or whatever the case is. So everyone's always looking for a good deal, and I get that. I'm a consumer too. But you also have to keep in mind you get what you pay for. And I've seen a lot of examples where people go and find the cheapest commission rate, but they end up paying more in the long run because they didn't necessarily understand the symbols. You know, for example, if you're trading gold's listed on COMEX, it's also listed on the LIFE, and if you don't know the difference between the two, you might make a mistake. That, you know, they have different margin requirements, they have different liquidity. So I mean, things like that can really make a huge difference. And just being able to have someone pick up the phone and have enough knowledge to help you out if your platform goes down, or or you just need to bounce an idea off someone, or you're having margin problems. Those types of things can save you a lot of money. So just keep in mind, commission matters, but it's maybe not what you think. Getting the cheapest isn't always the best deal. If you think of it this way, 1 point in the E-mini S&P is $50. A tick in bonds, the 30-year Treasury, is $31.25, and 1 tick in crude oil, which is like 10 cents in crude, and we all know crude moves 30 or 40, maybe even 50 cents at a time. It doesn't move a tick at a time. But anyway, you get the idea. I mean, do you really think that $1 or maybe even $2 in commission is going to decide whether you make or lose money? I know that it adds up. I'm not, it's not that I can't do simple math, but I'm telling you, paying $1 more when you're talking about a 50-point handle in the S&P, that's not what's going to make or lose you money. What's going to make or lose you money is your support staff, your trading research, your ability. You might only need, if you're an online trader, you might only need to talk to someone at your brokerage firm once every couple months or once a year. But that once a year might mean the difference between, thousands of dollars and $1,000 swing either way. I'll give you an example. In the flash crash, when all heck broke loose, a lot of the discount firms basically couldn't answer their phones. Everybody's platform was crashing. They just didn't have the staff to answer their phones. Clients couldn't get out of their trades. It was a complete nightmare. So if you don't have someone to pick up that you can call and pick up and trust to pick up the phone and help you to exit your trades or verify your trades, sometimes you can lose thousands of dollars on something like that. You might have saved $1 in commission, but you lost $1,000 because you're working with a firm that just simply is inadequate when things go wrong. And there's the true cost of trading, okay? A lot of traders focus on getting the lowest commission rate. But when you have a super low commission rate, you know what it does? It encourages you to trade more. It encourages you to trade more contracts and to trade more often. And this is really self-destruction. It's like you feel like you can because it really doesn't, it only costs you a couple bucks to get in, so you might as well do it. And you know what? It's going to come back and haunt you. Less equals more. So don't focus on the rate, focus on your behavior. This is something that people don't typically think about. When they talk about commission, they see, okay, it costs X number of dollars to do a trade. But what they don't think about is the biggest thing determining your commission bill or how much you pay per day or per month in commission is your behavior, not your rate. If you want to save money on commission, trade less. And you're going to be better off in your trading account as well. When you're trading higher volume, you have lower odds of success and higher transaction costs. So are you really trading money? If you're trading at a super discount firm and you feel like you can trade 1,000 contracts a day, no, you're not saving money. You're paying more in commission that way than you would be if you controlled yourself and traded a reasonable amount at a broker that's going to give you a little more support. And One last thing on commission. Know you're probably sick of hearing it, but people just don't think this way, and it's really important. So I want to stress this to people. The cheapest is not always the best. At the same time, the expensive isn't always the best either. There's brokers out there that'll charge you, crazy amounts for commission, like 70, 80 bucks round turn in commission. Just because they charge you that doesn't mean that there's some sort of value in it. In fact, I would probably argue that if they're charging you that much, they're probably doing it because they don't expect you to be around next month. They want to make their money today. They don't care what happens to you next month. So it goes the other way as well. But the goal, when you're trading, the goal is to make money, not to save it. You don't want to be nickeling and diming your broker or the markets and losing money in your trading account. If you're paying a super discount rate and you're losing thousands of dollars a month or thousands a year or whatever your scale is, it's not doing you any good. So you're not saving money. You're losing money. So it's something to think about. If being with a reputable broker saves you one tick in fill prices, you're already ahead. And I want to say this also, it comes into play when you're talking about like execution. A lot of traders that are trading with discount firms don't have access to open outcry execution, and this can make a big difference in option trading, or like if you're trading the big S&P, using a desk like the Mr. Topstep has an execution desk as well. You pay him a couple extra bucks to execute your trade for you, but tell you what, that couple extra bucks, you might have paid a little there, but you saved money on your fill because you're getting possibly a better fill price, you're getting better service, you're getting faster reporting and things like that. So again, don't nickel and dime the markets. It's going to end up costing you money. Even though you can't see it, it's not deducted on your statement, it's a cost. So again, if being with a reputable broker saves you one tick in fill prices, you're already ahead. And a good broker might give you market guidance, they might tell you support and resistance, they might have quicker tech support, they might have less aggressive forced liquidation. A lot of the discount brokers, they'll charge you a very, very low commission rate, but what that means is they don't have any leeway for risk. They can't afford for any trader to ever go negative or to ever even get, close to going negative. So what they do is they'll just force liquidate blindly. If they're a little nervous about how many contracts you have on, they'll just start shaving your positions down, and guess what? They'll charge you for it. A lot of them will charge you 25 bucks to do it. So it's really just not a fun situation. If you're trading with, you might pay an extra $1 or $2 to be with a good brokerage firm, but they'll give you a little more leeway. If you're a responsible client, but maybe you're having a rough day and you need a little extra margin lenience, they'll do that for you. They're not going to blindly liquidate your account and, maybe even send you an email. They'll say, hey, look, we'll give you a little extra room, place a stop order, be careful, and they'll let you go. It might mean better customer service. I don't know about you, but I can't stand calling in a 1-800 number and not being able to talk to anyone and getting passed around. Meanwhile, if you're trading in a brokerage firm that does that to you, you saved $1 on your commission, but you're on the phone waiting for someone to pick up your call while your positions are going against you because maybe your platform's down or you're having some sort of problem. It can be very frustrating, and it can affect your future trades. Also, going with a reputable broker might allow you to get into the markets with lower account minimums, or maybe even freedom to trade all products, open outcry and electronic. A lot of the discount brokers don't offer open outcry trading, and again, this can be a really, really big advantage, especially if we keep in mind situations like the flash crash. During the flash crash, a lot of the electronic options, like in the bonds, there were no bids or asks. The market makers just said, forget about it, we're not touching it. And so the only way to really execute your trades at a fair price was to call the floor and do it open outcry. But if you're with a broker that doesn't have access to open outcry, that one day, it might only be one day a year, but it only takes that one day to cost you thousands and thousands of dollars that could have been saved by simply using a reputable broker. Someone's asking what's a definition of reputable broker. Well, that's a good question. But you really want to make sure that it's somebody that has access to all the products, open outcry. They're someone that's going to answer their phone, and you can test brokers out when you run a platform demo. and you call and have questions, you'll get a really good idea of how well their customer service is. Can you get someone on the phone? Do they have a trade desk? If they do have a trade desk, do they charge you $1 million to use it? A reputable firm is not going to charge you $25 to use their trade desk. A good firm is going to let you, if your platform goes down, they're going to answer the phone, they're going to place your trade and help you out and not charge any extra to do it. All right, we're running a little short on time, so I'm going to speed up a little bit, but here's a couple things that you really just want to keep in mind as a day trader. Some of the pitfalls that people fall into is being undercapitalized, and I kind of talked about this before, but undercapitalized accounts might not have the means to hold overnight positions when necessary. You aren't doing your strategy any justice if you can't occasionally hold positions into the overnight session. Even if you call yourself a day trader, sometimes it makes sense to hold it into the overnight session or even into the following day. Technical patterns are not on timers. Another big mistake traders make is over trading. Day traders often have a propensity to always have a position on. They get bored and they force trade entry based on, just not having anything else to do, and it's not based on strategy. Being flat is not missing an opportunity. It's being safe from unnecessary losses. As we pointed out in the previously, those that are flat with the market are better positions to take advantage of promising opportunities when they do arise. So you're not missing out if you're flat. You're actually just preparing yourself to take advantage of better opportunities. I'm not a big fan of stop orders. That doesn't mean that you should never use stops. Some people use stops and they're good at it and they're happy. But in my opinion, I think stop orders might do more damage than good. I think possibly a better alternative is using options as stops, and this might mean going long a futures contract and buying a put and maybe even selling a call above the market to pay for that put, but doing something other than placing an outright stop. With day trading, it's a little more complicated to use options as stops, but just keep in mind that stop orders are meant to protect traders from losses, but multiple stop losses can add up really quickly. I mean, you might place tight stops on every one of your trades so your losses are limited, but if you keep losing over and over and over, a few bucks here, a few bucks there, it adds up really fast. I believe, and this is my opinion, that stop orders might actually work against the trader rather than loss protection. Not only do the small losses add up, but being stopped out before the market moves favorably creates an emotional turmoil that sometimes bleeds into future trades. And this is just an idea where it will show you, maybe how typical stop orders might have been hit before the market went their way. So like, let's say, for example, you're buying into support here. You place a stop where most people, again, place their stops in the same general area. So you might have had a stop here that got hit right before the market goes up. Someone shorting the trade might have been stopped out here before the market goes their way. So in this case, a stop would have worked really well. It would have done its job. But in a lot of cases, you'll see here, you'll see even here, maybe stops aren't so great. Maybe they're, they do a little more harm than good. But you have to be the type of trader that is able to work without stops, without letting things run against you, and that's hard to do. Not everybody can do that. Not everybody can do it all the time. Even people that are consistently good at that will have bad days. Okay, this is about the last idea that we're going to talk about, but position sizing is very important, and you can read lots of books and articles and watch lots of videos about position sizing, and there's usually these complex mathematical formulas and margin and leverage and all these types of crazy things. I like to keep things simple and slow as well. We recommend initiating a position with one contract per $10,000. Some traders trade 5 to 10 times what we're recommending per 10,000. I blame it partly on the fact that we're all human and we want, we're willing to indulge ourselves. But I also blame it on brokerage firms that overextend discounted margins and kind of glorify it. But just because you can doesn't necessarily mean that you should. Now, again, everybody's different. Some traders might trade 10 E-minis per $10,000 account, and they might do really well. But this is just what I've seen the majority of people, how they've handled the situation, and it's usually not pretty. I believe that less contracts, longer time frames, and price targets are a better way to go. And you might think that this sounds boring. Why, one contract per 10,000, why even bother? But think of it this way. If you're trading one contract per 10,000, all you need to do is make $50 per day. $50 a day equals $1,000 a month. $1,000 a month is $12,000 a year. So assuming that you are skilled enough to net $50 per day, and that's just one handle in the S&P, in the E-mini S&P, you started with 10,000, you would more than double your money in a year. So how boring is that? That doesn't sound that boring to me. It doesn't take 10 lots to make $50. Instead of trading 10 lots, trade one lot. And in fact, trading 10 lots likely decreases your odds of making $50 per day. Most literature that you'll read will tell you do not add to your losers, and I can certainly understand that adding to your losers can be a challenging situation, but I kind of think maybe some traders that are well capitalized and disciplined enough, it might actually be a great benefit to do so. I mean, adding contracts and adverse moves basically lowers the trader's break-even point. It's like scaling in and scaling out. If you're disciplined enough to properly add on to trades that are going against you, if you didn't go all in on the first one, if you nibbled and then nibbled a little more, you might actually have a higher probability trade than you would have had if you just went all in on the first signal. With that said, tread lightly and do not overdo it. So in conclusion, successful day trading requires discipline, less frequent, more logical trades, proper funding. You should leave yourself enough room to hold overnight positions if it's necessary, and really the most important thing is respect the market. I want to thank all of you for attending. Again, here's my contact information. And if you're interested in anything that you saw today or even learning about any of these topics, please take a peek at my books. They're cheapest on Amazon, but they're available anywhere.
Yeah, I would say if anybody has any questions, fire away for Carly. I mean, that was great stuff. Great rules too.
Also, if anyone thinks of questions after the fact, of course, email me at cgarner@dcarlytrading.com and I'll make sure you're all taken care of.